Good morning, friends, and again welcome to the Certain Wealth Group Investment Property Commentary, the last for 2015. Before beginning to write my December snippets, I took some time to read the past month's commentaries and undertakings from both well-known investment property advisors and many fly-by-night spruikers who are strong on selling and short on substance. So I spent the time looking, through the material because I'm always looking for good ideas. But my main objective was to try to determine what common thread was prevalent in what they were saying, because I'm a naturally cynical person. And then finally, in a conversation today with a client, it struck me. They're telling me, or the reader, the listener, how easy it is to invest in property. But it isn't. It's bloody hard. And very few people do it successfully. If it was that easy, why is it that 90% of residential property investors buy only one property and have sold that property within 5 years? So let me plainly tell you why. It's about misinformation, about not receiving the full story, and because those investors have not developed goals, or at least realistic goals. Therefore, they have no process for measuring their property portfolio performance over an agreed term, for example, 15 years. As an investor, we need to have decided what income we wish to derive from our property portfolio and how long we have set to get there. Investment property is not a short-term business, being at least 10 years and desirably a 15-year term, which you normally set to reach one's goals and to produce the desired income that you're looking for, while still continuing to grow your equity for the future or to pass on your properties to future generations. Maintaining goals is often hard. We all have competing interests for our spare funds, such as a new car, holidays, school fees, orthodontics for our children, home improvements, and so on. And these are all competing with our investment program, right? Wrong. Why? Because after a few years, with capital growth from our property and increasing rents, we will achieve a yield of about 5%, which is close to neutral gearing, not dipping into your pocket all the time. Therefore, with expenses, interest, and depreciation deducted from our other income sources, mainly our salary, which we're paying heavy taxes on, we should not need to be dipping into our pocket any longer. And in an ideal position, to sensibly purchase our next property, utilizing about 80% of our new equity. Therefore, the person who has their clear goals in place and review them at least annually, preferably with the assistance of a professional, they are likely not to be the 90% who purchase only one property in a lifetime and who sell out within 5 years. So apart from my harangue to you on making sure that you have goals and having those goals checked, I also want to pass on to you just a little information to do with banks. As investors, you need to be aware of any changes, particularly subtle changes in lending policies of the Australian banks, and I want to explain something here now to you. So a little about these bank loan changes. The banks have changed their lending conditions to the interest of the banks, of course, and have included a number of things. Higher penalty interest for property investors, that is, a little bit more interest than you would pay if you're buying your own home. Tougher mortgage insurance, cost of living calculations that disadvantage the borrower, relatively high charges for higher income borrowers, which seems a very strange thing. Tougher, often unreasonably so, valuations that are $30,000, even more, $50,000 below the true value of the property. Tougher conditions for multi-investment property owners. Further, some banks are not computing negative gearing in their calculations. Many are doing their client affordability computations based on 8.4% interest, a number far above the 4.8% still attainable, and the 6.2% that has until recently been used to compute affordability, that is, should we see an increase in interest rates. With these changes that have been subtly introduced and certainly not published, Certain Wealth Group recommends that property investors choose mortgage brokers rather than approaching one or more banks directly. Going to a bank, you can get one proposal, one deal, maybe a couple of deals, but by going directly to a mortgage broker, a good mortgage broker who's very experienced, you will get the whole array of things that are available. We can provide contact details for good brokers, as you know. We recommend a few people who we know are real professionals and who have been able to be very successful with clients in the past. While I'm tempted to say many other things, I shall not do so. I just again reiterate, regular reviews, at least annually, are very, very important to you. Secondly, are you investment ready? Are you ready to acquire your next property, or do you think maybe you are, or you want to know what you need to do before you are ready to do so? We're more than happy to work with you. We're going to be here over the Christmas period. If you wish to do a property inspection during that time, please contact us. You've got my details, but they'll also be on the bottom of this video. Please feel free. It's a good time when you have a break over Christmas to be able to bring down maybe the children and to do your inspection at your ease. I think there are less and less properties available at the present time. Melbourne is very, very tight, very, very strong in terms of its growth compared to the other capital cities at this time. And it just finally leaves me to say best wishes to you over the Christmas period and the summer holidays. If you're traveling, keep safe, and I wish you and your family the very best over the Christmas time. Thank you for now from myself and our staff at Certain Wealth Group.